Fixed mortgage rates continued to plunge this month, as did variable rates as the discounts got bigger. And while there's no expectation that the Bank of Canada is going to increase interest rates this week, we will be getting additional insight as to what is coming down the road as they release their monetary policy report. But at least for now, it seems that the spring market is bringing more competition from some of the biggest lenders in Canada, and that's a good thing for homebuyers and borrowers, especially with the Canadian real estate market continuing to heat up. But before we get into all the details, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit that subscribe button and hit that like button so more people like you can see this video. And don't forget, you can still get my new book, Mortgage Secrets, at mortgagesecrets.ca for free. All you have to do is pay the shipping and handling. This is the insider guide on how to get the lowest mortgage rate in Canada, and I guarantee you, if you plan on going through the process of getting a mortgage in the next 6 to 12 months, this book will save you thousands. Okay, so let's discuss what's happening in the Canadian interest rate market because it is really wild out there. We're starting to see competitiveness that we would typically expect heading into a spring market as different lenders start to vie for market share. And even with bond rates increasing slightly, we're seeing some lenders still drop interest rates in the hopes that they will become the preferred lender for home buyers and people who are coming up for renewal and are looking to move their mortgage to a slightly better lender. And by the way, if you have a mortgage that's coming up for renewal, there's a high likelihood that there's a better lender out there than the one you chose 5 years ago because, quite frankly, if you've held a mortgage for 5 years and it's coming up for renewal, your circumstances have almost certainly changed. So make sure if your mortgage is coming up for renewal that you're making sure that you're out there and shopping around. Don't just sign the renewal offer from your bank or from your lender. Now, I want to paint you a quick picture of what's been happening in the Canadian bond market because the bond market largely affects fixed rates. Yes, the Bank of Canada has some influence over it, but what really drives the market prices for fixed rates is the Canada 5-year bond. And the last 90 days have been very much a roller coaster for the 5-year bond. As you can see, in January, the interest rates were starting to come down. Around mid-March, as expectations about interest rates started to change, we saw a pretty significant increase in interest rates. And then with some positive inflation data, we saw those interest rates come back down. And as of right now, we're seeing interest rates that are very consistent with the expectation that the Bank of Canada isn't going to make any near-term moves. And if we go back and we take a look at the 12-month chart, you can see that interest rates are kind of floating around where they were about August of last year. And while we can't necessarily predict where interest rates are going to go, this does feel like interest rates are flattening out in line with the Bank of Canada's guidance that they were going to take a wait-and-see approach. And with that wait-and-see approach, we are again starting to see those fixed rates come down, and we're starting to see banks get more competitive, both on variable and fixed rates. So as we do on our monthly mortgage interest rate updates, I'm going to take you through all the available rates on the market right now. Now, keep in mind that these can change very quickly, so if you're watching this a week or two down the road, there is a chance that these are not going to be the rates that are available. So you want to make sure that you're keeping an eye on these. And if interest rates start to go up, you want to make sure that you've got rate holds in place. Now, what's a rate hold? That's simply when you have a broker or a bank, preferably a broker, lock in interest rates so that you're protected for a 120-day period. And I'll get into a little bit more about why you want to have those rate holds with brokers rather than banks, but let's start by simply saying that it's 2023 and getting your mortgage directly from your bank is just something that the majority of Canadians have now figured out is not the wisest choice, especially if it's a 5-year fixed mortgage. So I'm going to jump you in and I'm going to show you exactly what's going on with interest rates. I'm going to start with the 5-year fixed full feature mortgages. Now, these are the mortgages that have the best features and the best penalties, because you want to make sure, especially in an environment where interest rates could potentially go down in the future, that you have low penalties so that you have negotiating power midterm. This is hugely important. And this also means that you don't want to be getting a 5-year fixed mortgage at a big bank. You want to be getting them from lenders that specialize in mortgages, that can't skate on their big brands and their marketing budgets and actually have to have better products. These are lenders like MCAP, First National, and CMLS, to name a few. So the mortgages I'm about to describe to you have that combination of big bank features, the ability to prepay the mortgages really quickly, all of the portability options, as well as the super low penalties, which are hugely important. And this is true for variable rates as well. You kind of want to be avoiding the big banks for variable rates for two reasons. One, because of the fixed payments, and also because if you at any point want to lock in, you want to make sure that you've got options down the road to pay out the penalty on your fixed rate mortgage to get a lower interest rate if the opportunity arises. So 5-year full featured mortgages, these have gone down since last month. In fact, I think you'll see a theme here. Almost every single interest rate has gone down since last month. Insured full featured mortgages are currently 4.64%. This is a great rate. By the way, if you're looking at 3 and 4 year mortgages, The 5-year mortgages have some of the best rates right now, pretty much across the board. It's infrequent right now that we're finding a better rate with a better mortgage on a 3 or a 4-year. So the 5-year seems to be the flavor of the day, at least until interest rates on those shorter term mortgages start to go down below the 5-year fixed. Now, when you get to the point where you're putting 20% down payment, interest rates obviously go up. This is because this is where the banks have the most exposure. They don't have the insurance anymore. And if they do have something that's called back insurance, it's the most expensive at the 20% down payment range. And back insurance is when the lender insures the mortgage on your behalf and you don't have to pay for it. Although, as you can see here, you pay for it via a slightly higher interest rate. So currently 20% down is 4.94. This is better than last month as well. 25% down, you're looking at 4.89%. 30% down, you're looking at 4.79%. 35% down, you're looking at 4.64, which is back to that insured rate. That is because at this point, the likelihood of somebody walking away from a mortgage where they put 35% down is very, very low. So the pricing gets more in line with insured mortgages from a risk perspective. And then this is the big one: uninsurable, refinance, over $1 million purchases, 30-year plus amortizations. These rates have come down substantially since last month. As of right now, we're looking at 5.04%. So if you're looking at a mortgage with a 30-year AM, or you're looking at purchasing a property that's over $1 million, these are very much the mortgages for you, and they've now again refound their competitiveness. Now, moving into full featured variable rate mortgages, these ones are going down as well. You can see that prime is still 6.7%. It is widely expected that this will remain 6.7% going into the next month. And then looking at insured mortgages, you're looking at prime minus 0.9, so basically 5.8%. So I can't really justify taking a variable rate mortgage when you can get a fixed rate mortgage for so much cheaper than what a variable rate costs. But if you're looking for a short-term purchase and you know that you're probably going to be out of the market inside the 5-year term, well, this might be the right option for you. But for the most part, it looks like fixed is the better option at the moment. By the way, I cover how to determine whether you should choose a fixed or variable rate mortgage in my Mortgage Secrets book. Now, going into 20% down, you're looking at prime minus 0.55. At 25% down, you're looking at prime minus 0.55 again. And then at 30% down, prime minus 0.75. And 35% down, you're looking at prime minus 0.9. And for those uninsurable refinances, this is actually the one rate that has gotten worse. That is the variable rate over $1 million purchase price, 30-year amortization refinance rate. And it has actually gotten worse. It's only at prime minus 0.25 right now. So probably not a good option for most people. Now, moving into discount mortgages. So these are the ones where you have to be careful. The reason why is because just like anything else in life, if you want to pay the lowest price, you're going to have to give up some options. That's just the way it works. And in the case of mortgages, what you give up is mostly quality. And there are also some restrictions that come along with a lot of these discount mortgages. And when you have restrictions and you have the inability to move to a different lender, which is the biggest downfall of these types of mortgages, well, you lose all of your negotiating power, especially midterm and especially if interest rates go down. So in other words, if you choose these rates, you're stuck. And by the way, it is almost always the people who say, yeah, you know what, no big deal, I'm not planning on making any changes in the next 5 years, that find themselves in a situation where they shouldn't have chosen these mortgages. Because things like relationship breakups and things like lower interest rates that come down the road are just things that you cannot predict. So if we look at these mortgages, again, I can't justify these even with the substantially lower prices, but hey, if you want them, we'll help you get them. Looking at 4.39% on a 5-year insured mortgage. At 20% down, you're looking at 4.79. At 25% down, you're looking at 4.59. At 30% down, you're looking at 4.49. And then at 35% down, you're looking back at 4.39% again. Now, when it comes to uninsured mortgages, these typically aren't available, and they aren't the type of mortgage that you would want to get anyways. And then going into 5-year variable discount mortgages, these are looking really, really good from a competitiveness standpoint and a discount standpoint. Unfortunately, the high prime rate makes these probably not something that people are going to choose anyways. But if you want to take a look at them, insured is prime minus 1.1%. 20% down is prime minus 0.75. 25% down is prime minus 0.75. 30% down is prime minus 0.95, 35% down is prime minus 1.1 again, and then again, these are typically not available on uninsurable mortgages. If you're getting a mortgage on a property that is over $1 million purchase price, or you're getting a 30-year amortization, or you are refinancing, you simply can no longer expect to pay the lowest interest rate. So don't be surprised when those interest rates come out slightly higher than what you're finding when you're doing your online interest rate searches. So those are the rates for April of 2023. My expectation is that we're going to see minor fluctuations in these, but they're probably going to stay pretty flat at least for the next little while, especially if the Bank of Canada doesn't make any big interest rate changes. Now, the one thing that could have an effect is that monetary policy report, which depending on the forecast and the data that come out in those, you could see a change in the bond yields, which could ultimately affect those 5-year fixed rates. But only time will tell to see what comes out in those. Oh, and by the way, if you're watching this video, you're probably in the market for a house in the next little while. So make sure you check out this video here to see exactly what's happening in the Canadian real estate market.